Good afternoon, ladies and gentlemen. Welcome to the Quiz PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab, just situated on the right-hand corner of the screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during today's meeting. However, the company can review all questions and will publish any responses on the Investor Meet Company platform. Before we begin, we would like to share the following poll, and I'm sure the company would be most grateful for your participation. I'd now like to hand over to CEO Tarek Ramzan. Good afternoon.
Hi, good afternoon, everybody. Welcome to Quiz Audited Final 2023 results. I'm pleased to say that during the year there's been strong revenue growth and return to profitability. Financial highlights: group revenues increased 17%, gross margins improved to 61.6%, and EBITDA generated of 6.2 million, which was over a million improvement on the previous year. Improved PBT of 2.3 million, and that was a 1.5 million improvement on the previous year. Cash flows were also strong, 5.9 million in the year, which was 0.6 million more than the previous year. Just some operational highlights. There has been growing customer demand further to the removal of social restrictions and increase in events, which we also were restricted us very badly during COVID. There's been a continued focus on our own stores and website. We've been growing those two channels, and there's been an increase in online revenues of 13% and increase of active customers of 11% on the previous year. We now have, at the end of the year, we had 62 stores in the United Kingdom and 6 in the Republic of Ireland. Previously, we had 62 in the UK and 5 in the Republic of Ireland. I'll just hand over to Jerry now. CFO.
Hi there, good afternoon. Just take you through some of the financials, just a little bit more detail. I'll touch upon that. And obviously, happy to take any questions on them as well, if you want to submit them. So, as Tarek's summarised already, it's obviously been a positive year for us in terms of the growth in revenue and profitability. I think we've seen, probably talk about it, but we certainly saw very strong demand in the first half, with that falling away a bit in the second half, or moderating in the second half. Certainly this calendar year has been more challenging. Some of the cost of living pressures have started to impact people and their spending choices, or spending ability. With regards to gross margin, we'll talk about that in terms of what's driving that, in terms of it's obviously been positive. We're pleased with the cost control is a big aspect within the business, given the kind of importance of that. That's been positive during the year, 15% uplift in operating costs, obviously managing to keep that below the increase in revenues, and we want to talk about some of the detail of that in due course. So just with regards to the sales and where they have come from in the current period, stores and concessions, very, when you see good uplift there, you'll see, turns up 24% year on year. We saw very strong like-for-likes in the first half and the year, kind of moderating in the run up to Christmas. And, there has been a reversal in that in the current calendar year. But that pattern's there. So quite pleased with that in terms of how the stores are performing, especially in the back of the restructuring that we did go back a couple of years ago now. That's continuing to benefit us in terms of the store estate, in terms of the mix there and the rentals arrangements we have. Online, similar pattern in terms to across the year. Our own website grew by 13% in terms of the revenue there. Third parties, we deal with a number of them. There's been a bit of coming and going with them during the year, but sales with the third parties are up 9%. With regards to the international, the growth there is really driven by the Republic of Ireland, which was more restricted by COVID than the previous year. So there's been a bit more of an uplift there. The international side, actually, in terms of the beyond Ireland, in terms of the international side, it's actually dipped down by 6% in the year. But that is largely due to us exiting some of the smaller partners that we dealt with through that period. Our main partners have seen the kind of uplift in sales that we have experienced in the UK as well. And then just an overarching comment on the gross margin, just obviously that was a positive for us. It's actually, you'd have to go back a number of years in the business where it's been as strong as that. So pleased with that in terms of the performance there. In terms of touching on some of the costs, just highlighted some of the main costs there to touch upon. The administration costs, primarily are made up of employment costs. The 8% rise there will be kind of driven largely by the increase in rates of pay. National living wage and 15 months ago went up by just short of 7%. So for us, that kind of drives an increase through the business and keeping differentials with people. But there's also been more activity at the distribution centre with more revenue being done as well. So there's a few more heads working in there in terms of that. Property costs, it's the same mix of rent and service charges and rates. Rates is the primary driver to the change there. If you excluded rates and the costs, property costs have only gone up by 7% in the year. A little increase in the rent and service charges paid, but we were the beneficiary of some of the waiver of business reliefs in the previous year. So we're back to normal in terms of what we pay there, in terms of that 2.5% or 2.5 million uplift, I should say. And actually, in terms of the overarching costs, if you took that out of our cost increases in the year, excluding the change in rates, our costs have only increased by 9% across the year. Marketing spend, Shiraz is going to talk about in due course, generally tracking revenue in terms of what we're investing in that. Distribution for us is primarily, the way we deal with it, commission that we pay to third parties is treated as a distribution cost. That just fluctuates with the level of sales there. Carriage costs, we'll come on and talk about in a bit more detail, but that's gone up about 20. What we're paid for carriage is gone up about 20% in the year, and obviously there's been a degree of fluctuation in costs paid for that. Web costs are relatively neutral once we factor in what people pay for deliveries versus the cost of deliveries. Just over the page, just to touch upon the balance sheet and what we're placed at the end of the year. I think one of the things I might have mentioned last year, or I should have mentioned 12 months ago, was coming out of the restructuring that we did in 2020. There was a need to renegotiate a number of leases, especially in our main sites, where the restructuring effectively we entered into 2-year leases at the time of COVID. So we've been renegotiating and extending a number of leases through the year, and that's what's led to the average lease length going up from 15 to 23 months. And that's obviously that's also the driver for the increase in the right to use assets you'll see there, which has gone up by 5.4 million. That's just really a reflection of rental payments you're committed to going forward. So as we've entered into the new or extended leases, then that's what's driving that. As far as the other capital expenditure, we effectively opened 5 stores in the year, 3 new ones, 2 in the UK and 1 in Ireland, and we relocated to 2 stores, which was from a cost perspective, as good as similar to cost to reopening a new store. So that's what's the main factor driving the spend there. Continue to invest in the web, £500,000. A little bit of spend at the distribution centre during the year in terms of the infrastructure there, just keeping that maintained there in terms of replacing some equipment. Working capital, pretty much nothing really to highlight there too much. Stock, in terms of the cost of stock that we hold, it's gone down 300,000 year on year. So that's as we've actively managed some of the older stock out of the business. That's obviously been negated by some new stock coming in to facilitate the increase in sales during the year. So the net effect of all that, as you'll see, the increase in net assets at the bottom of 2.2 million. Just lastly from me for the moment, with regards to that, the cash flows, it's really a reflection of the points I've talked about earlier. There's the stronger EBITDA. We're back into a normalised kind of tax situation. Last year we had a lot of tax losses, which were led to tax losses and allowances, which led to the large tax credit. But as I say, it's more normalised in that context. As you see, spent that money, more money invested into the business the current year. So similar operating profit or operating cash flows, being more investment back into the business. Obviously this morning we did update with regards to the current cash position, so I'll just touch upon that just now. Effectively our net cash has declined by 2.8 million in the last 3 months. The cash is down by about 3.8, but 1 million of that is paid off loans, so hence the 2.8 figure. The capex in the last 3 months we've actually spent £1.5 million in terms of what we paid out in terms of the new stores and the work going on in the distribution centre. So that's a large part of it. Another large part of it is just the pattern of sales, especially in terms of our international customers. Quite strong sales there in the last couple of months, so the trade debtors will have increased and that will be collected in due course. So those are the kind of combination of capex and working capital movements as opposed to kind of erosion of cash. So that just to flag that up at this point. So I'll hand over to Shiraz for the moment.
Thanks, Jerry. I'm Shiraz, Chief Commercial Officer. Just to talk to you a bit about our online channel. So as you've seen, as Jerry sort of mentioned, we've seen an increase in demand for occasion and dressy wear, which is reflected in higher sales through the Direct Quiz website. That's about a 13% uplift in sales. Quiz Direct sales now representing around 70% of our online sales, is slightly up on the previous year. Active customers have increased 11% to 622,000. We've also seen positive improvements in conversion rates and ATVs, which is encouraging across the board. In terms of our third-party partners, we've mentioned previously we're working with Next and the Very Group. Next, we've actually moved on to a wholesale model, so we're growing that channel, which is going quite well, and we're operating with Very on a dropship model. Overall, across our third-party online partners, we've seen growth of around 9% over the year. I think we mentioned previously about some of the IT investments which will impact stores and online with our omni-channel systems. So that's well underway. We've got some positive developments with the new IT platform, and that's being rolled out in phases over the coming months, starting with store tills, which have been rolled out through the remainder of July and August across all our stores. We have a new online platform which is going live in August as well, and our head office systems are moving over to the new platform early part of next year. Some of the advantages that the system will bring will be single view of stock across the business, across stores and web. We'll be able to fulfill web orders from store stock. We will be able to fulfill click and collect orders from store stock and potentially offer same-day click and collect services. We'll be launching loyalty programs as a result of the new platform, and we'll have a single view of customers. So there's quite substantial benefits that we'll be seeing from the implementation of the new project across online and stores. In terms of the actual store estate, the concession estate, as we mentioned, we're pleased with performance across that area of the business, and we've returned to a decent like-for-like levels there. We maintained flexible rental arrangements across stores. So when it comes to leases with landlords, we have an average term of 23 months, and we maintained flexibility with ideally no more than 5-year leases. and in a lot of cases break clauses within that 5 years, so we're not pinned down for too long. We mentioned previously we've opened about 5 new stores in the last year or so. All stores are actually performing quite well and achieving targets. We're quite happy with the new store concept and how those new locations and relocations, some have been upsized locations within existing centres. We're quite pleased with how those are all doing. In terms of the concession arrangements, our biggest concession partner is New Look, and we've seen a few increased outlets there, again performing quite well from a financial perspective, not staffed by Quiz and low capital outlay, so it's a nice channel for us to continue pursuing. Overall, across stores and concessions, overall across concessions, there's about 67 outlets versus 69 last year. So just over the page, just to talk a bit about margins. So we've seen an increase in gross margins and improvement in margins due to the demand for new product and a positive reaction to new ranges throughout the year last year. We've seen an increased proportion of full price sales as a result of that, and that's driven gross margin up to 61.6%. There have been some pressures. Last year we did see some pressures in shipping costs. This year actually we've seen some quite marked improvements in freight. Air freight has dropped to around about 30 to 40% lower than last year. Sea freight has dropped to almost 70% lower than last year. So we're quite pleased with how that will filter through into the value proposition, which we aim to continue with this year. As I sort of mentioned on that value point, consumers have been looking for newness, but have been looking for good value and lower price points. So we've continued to react to that by offering a wide range of price points to offer the consumer a variety depending on what they're looking for across our dressy occasion ranges overall. In terms of cost of goods, there has been around about 4% uplift in cost of goods, and we've reacted to that with roughly a 5% uplift in ASP. However, as I mentioned earlier, we're looking to maintain that value proposition as we continue to grow the brand this year. Just over the page to talk about infrastructure. So we believe that the company has a strong infrastructure which is well positioned to facilitate long-term growth. So I've talked a bit about the omni-channel system which is being phased in over the coming months. On top of that, we've commenced with about £1.3 million investment in our DC facility this year. That's going to increase capacity. Some of that is down to the building of a new mezzanine and software improvements, which, as I said, will improve capacity and improve efficiencies with shorter pick routes through the DC and better throughput of goods. There have been some cost pressures with national living wage increases and reinstatement of business rates. We've actually seen some of that continue into this year with some employment cost increase and renewal of energy contracts. However, the management team remains focused on proactively managing those cost increases and looking to maintain that differential of higher sales increase versus cost increase as we move the business forward. So just to talk a bit about marketing over the page. So just to touch upon the USP, as you know, we've developed quite a distinct USP and we've differentiated the brand, becoming a destination for occasion and dressy wear. We've got we appeal to a broad age and we offer a good range of value price points. Our aim is not to be the cheapest, but our aim is to offer the best value for the type of product that we offer. In terms of marketing, we've increased spend by about 17% to 2.7 million in the last year. And a lot of that has been focused on digital marketing, which is very performance orientated. We look to achieve a clear return on investment on any marketing that we embark on. We've actually engaged with a few new digital partners in the last year. That's resulted in improved Google rankings in terms of search optimization. If you look for dresses on Google, you'll find Quiz quite highly ranked in that area. And we've also made investments in our social media in the area of social media with new appointments within our social team. We've also invested in some new social media management platforms. That's allowed us to enhance our activity and gain better traction across all social platforms. We're actually seeing some very good results from that, and we're looking to continue to grow our performance across social channels. It's a key area of focus for us. And overall, in terms of marketing activity, our aim is really to grow brand awareness and to stay in the front foot with our marketing campaigns and to continue to push Quiz as being the destination brand for occasion going out whether that's for events during the day or night. So I'll just pass you back to Tarek.
Just to speak about a bit about current trading. Current trading has been challenging. We're up against strong previous year comparatives when there was a much increased demand for dressy and occasion wear, and we're also up against the cost of living pressures. So it's been well documented in the press about all the pressures that retailers are facing. The stores, the total sales are down minus 15% from 2023, but that is broadly similar to 2019 on a like-for-like basis. Gross margin is broadly consistent with the prior year. We have utilised some more of our cash, and that partially reflects spend on 3 new stores and initial spend on expansion of the DC and the IT expenditure that we're taking on board. We still have total liquidity of headroom of 7.1 million, which is broadly similar to the previous year. So as far as outlook is concerned, short-term considerations, as I said, challenging trading conditions, which has been reflected in recent sales. After the summer, the comparatives are not as strong, so we feel that trade will be better for us moving forward. We are looking to maintain margins and we'll continue to control costs as much as possible. Given the sort of uncertainty with the coming year and inflationary pressures, etc., we anticipate full year 24 profit to be broadly similar to full year 23. Longer term considerations, we're confident that the strong brand and business model remain relevant and attractive to customers. We're still investing in the business. We're still continuing to invest in our infrastructure, in our DC and our IT systems. There's some major spends happening at the moment. We are opening more stores. Since the end of COVID, we've actually opened eight new stores so far, and all those stores are performing in line with expectations, so we're quite pleased with that. So we're looking to open more stores as if the right locations and the right terms come up. So we're actively searching for good deals in the market. We're also focused on development of the Quiz web sales, and we are speaking to 1 or 2 new third parties as well. We will be also increasing international sales. We're speaking to 1 or 2 new partners in the Middle East and the USA. We've just recently started trading with a partner in the USA, so that has got off to a good start. We're also looking to leverage off existing infrastructure to limit our cost increases as revenue increases. That's important to us, and we're confident longer term the business will grow revenues and profits and deliver shareholder returns. So the message is that we're still investing in the business, staff, IT, DC, new stores, opening more stores, etc. And we're still excited for the coming year. We're reasonably confident for the coming year. And I would just say thanks to everybody for coming. And you're welcome to answer questions then.
That's great. Tarek, Shiraz, Gerard, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company just take a few moments Just to review your questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of these slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Jared, if I could just ask you maybe to open up that Q&A tab on the right-hand corner of the screen. You'll see you received a number of questions from investors throughout today's meeting. So firstly, thank you to everybody for your engagement this afternoon. If I could just hand back to you to read out the questions and where appropriate, respond, that would be fantastic. And I'll pick up from you at the end.
Sure. I'll just take them in the order they arrived. So the first question I had was with regards to Sheen and how much of a competitive challenge it is to Quiz. So
yeah, I'll answer that one. So Sheen obviously have made quite a big inroad in the UK and global fashion markets. They're an online-only brand, and they have impacted, from what we can see, quite a lot of online-only fashion brands. In any market research we've done, we've not only seen Sheen rank significantly as a competitor. We are aware of them, but obviously we are an omni-channel brand, and we've got stores and other channels that we operate in. We're also not set out to be the cheapest. I think brands that are offering, to be the cheapest in the market are being directly affected by Sheen. So our aim is to offer dressy, going out occasion products for day or night at value pricing through an omni-channel model, and we don't see that as a direct threat to us.
okay. The next question was with regards to the cash difference between year end and now, but which kind of touched upon a little bit, but at the heart of it is a question with regards to how much is it cost us to fit out or open a new store. So that certainly varies in terms of that. We're probably averaging somewhere between $250,000 to $300,000. I think there have been some stores that cost us notably less than that in terms of the arrangements we've had and the store that we've taken on. But our flagship stores like Lakeside or otherwise, they would be above the average in what we would spend. So that's the level of spend that it takes to open a new store. With regards to, I think in terms of overall cash movement, I think there's a couple of questions later on with regards to that as well. As I say, that different, and there's a comment with regards to how the cash moved in the previous year, and one of the questions. Firstly, I think it's clearly obvious. There's that £6 million difference in sales. Obviously, it makes quite a big difference in terms of when you're comparing the cash movement in the 3 months this year to last year, in terms of that having an impact. But as I say, there are working capital movements behind this as well. The 1.5, 1.6 million was spent on capex in the last 3 months in terms of cash getting out the door, but there is also some build up in working capital, which has driven the kind of adverse cash movement in the last 3 months. So that's part of it as well. Next question was with regards to, would we consider acquisitions in terms of, are there opportunities there for us in terms of to join up or to acquire with the complementary businesses? So I think you can all chip in there as appropriate, but it's probably not a priority for us, is the short answer. Obviously, if there are opportunities put across our desk to consider at various times, but it's not an active priority for us. But obviously, if something came along that was of interest, we would have a look at it as appropriate.
Yeah, agree with that.
Next question was just with regards to the distribution centre and the spend there. Which went on to talk about how that will impact our rental arrangements, which is, as some of you may know, we don't own, but we lease the distribution centre. The rental arrangements there are fixed, running through for the next 3 or 4 years. That's all done in an open market basis. So that'll be, it's not going to impact the rent that we pay for the DC in the short term and the spend that's been done. So Any plans to improve the digital experience? Shiraz touched upon that with the item project, and do you want to expand on that, Shiraz?
Yeah, so the item project is a full omni-channel system which will replace our online platform, our store IT systems, and our head office IT system. So as I mentioned, that will give us single view of customer, single view of stock, and allow us to fulfill web orders from anywhere in the state, offer same-day click and collect services. So there's lots of benefits there, which I think we will hopefully see the rewards of over the coming years.
Okay. Just with regards to, there's a question with regards to the proposition, we'll come back to maybe at the end. Leo submitted a question just obviously highlighting the fact that within the statement we had flagged up that our expectations for the current year with regards to profit would be similar to last year, and he was inquiring with regards to just how much of an impact the fall in revenues in the first quarter would have upon us, and that and fulfilling that expectation. I think the pattern last year, as we touched upon earlier, we obviously did see very strong sales in the first half, especially in the first quarter last year. We do, think we're now moving into a period where that comparative is not as difficult to achieve. I think there are opportunities for us in the second half of the year to certainly match, if not beat, last year's numbers in terms of revenue. So that's, it's a mix. Certainly, there's no, it would be self-evident to say if the revenue is down by the level it is, then the profit we've generated in the first quarter is lower than last year. But our plans and our expectations for the current year is that we'll make that up across the year. So there's a question with regard, a couple of questions with regards to supporting the share price, what can be done, and the fact that institutional shareholders, there's been no great shift in that across the year in terms of we've got the same primary shareholders as last year, and what can be done to attract that. Yeah, obviously, I think when we did this presentation previously, there's been questions with regards to, would we do something actively, buy back shares or otherwise to support the share price. As I say, we're kind of focused on investing into the business to try and improve the performance to get more consistency there. I think it's, again, the institutions, there's been, again, being brutally honest about it, there's been some interest, but obviously there's not been any great uplift in the investment they've had in the last few months. But, as you all know, the consistency of performance that helps us with those conversations. The question just submitted with regards to margins and profit before tax from Gavin. On that, again, if you went back historically, we would have been generating margins of 10% at an EBITDA level, close to 6 or 7% once that's PBT level. There's certainly that's the aspiration, is to rebuild margins to that level. We're certainly conscious of the need to do that, but scale is going to be one of the primary things that does that in terms of the infrastructure the business can support a higher revenue. So that's the thoughts there. So sorry. Our factory prices falling now in terms of input prices.
It's the reduction in freight and is improving input prices. So factory prices are aren't particularly falling. It's more the freight aspect where we've seen improvements.
Just question from Dan again, just with regards to New Look. Do we see ourselves growing with them, or maybe retracting if as been reported, maybe they are looking to close some stores?
We've got quite a flexible relationship with New Look. We're looking at some new sites. If they close any, we will obviously do so as well. But it's not a particular key channel for us. It's obviously our focus is more on our direct operations to our own stores and through our own online channel.
With regards to this question, with regards to leases and the proportion of turnover rents, we've got a mix of leases, obviously some on fixed rents, and there's about 15% of leases we've got on fixed rents. There's about half the leases we've got are on purely turnover rents, and the balance would be a mix of that, where we may pay a relatively small fixed rent, but in essence it's a turnover rent. So I'd say the majority of the leases are still revenue based. So. What's our return rate and what do we do in terms of processing them?
Yeah, return rate at the moment is just over 40%, about 42, 43%. It's actually tracking a bit down in last year. We've introduced a returns processing fee early this year. So that's something that we've done to obviously improve profitability and improve performance of online and the handling of returns. We haven't really seen a direct impact from that. I think some of the reduction in return rate is down to an increase in casual wear this year, which we've seen come through in terms of fashion trends, which generally results in lower returns than dressy wear, for example.
Question in regards to CapEx expectations for the current year. Probably expect that to be about 3 million in total. Same with the distribution centre, the stores, and there's continued spend on the IT side. So. Question in regards to no director share purchases, just to deal with that. Obviously, during the last 6 months, we've had, I think it's 6 or 9 months, and 2 of our non-execs buy considerable amount of shares. And just with regards to the family, their position is they collectively own just about 49% of the shares. So actually, for them to buy shares, it would actually potentially trigger a requirement to take over the business. So that's one of the reasons they would not have been unable to buy shares in the past. Just a question there coming from Zoe with regards to third-party sites, with regards to how important they are. And
I think the third-party partners, selected partners, are important. They, help improve brand awareness, and they help offer quiz to a wider range of customers. So our key partners at the moment are Next and Berry. We are speaking to 1 or 2 new partners, but as you've seen in the figures, the trend is for our online channel to be the key area of focus, and that's where we're sort of gravitating the business towards. So key focus is to grow our own online channel, direct channel, but we will work with selected third-party partners. There are advantages in doing so.
Just last couple coming in here, just with regards to full price sales and comparing the performance today in terms of what reported against Next, which is obviously got a much broader base in terms of what they offer.
Yeah, I mean, just on that, Next do have a much broader offering, and they've got much more of a family offer with their product proposition. I think obviously Quiz is quite occasion and going out focus, and last year, post the removal of COVID restrictions, we saw a very high bounce in demand for our proposition for going out. Obviously, people were going out to weddings, holidays, events, parties, and that's right up our street, really. So we saw a very big bounce last year, possibly more than maybe what other brands would have seen. But this year, there has been a decrease, but we are, as a team, quite confident because we're trading quite positively compared to 2019. So I think really that explains some of that trend.
Just very quickly, there's one about cash. James is just asking, would we need to raise funds? It's certainly not on the horizon for us. We have what we're forecast and what we're working to, and what we're comfortable with the cash we've got and the facilities we've got in place. So I suppose just to cover off maybe our last question from Chris, just with regards to the longer term prospects for the business. Maybe I'll hand this one to Tarek, just in terms of the proposition of the business and how we see it going forward in terms of the strengths.
Yeah, we still feel there's a strong demand for the Quiz brand and for the Quiz USP. We're also see expansion possibilities ahead of us on the web. Our web can grow over the next few years. We're opening more new stores, so we anticipate revenues to grow up. As I said before, we've opened 8 new stores since the COVID restrictions eased, and all those stores are trading well. So we still see that we can open quite a few new stores. We see that we can expand on international, etc. And we're also looking at increasing our product ranges. We're looking at doing more casual and more carbon, more petite. So we see plenty of room to grow in the business. And in the long term, we feel that we'll be able to deliver the profits and turnover that we're looking to do, and that should result in increased valuation going forward.
That's great.
There's been maybe a crossover in questions, but if anybody feels they've not addressed anything, we're more than happy to pick up on it after the meeting. So.
That's great. Thank you very much indeed. And as I say, for every question you seem to answer, there'll be another one that pops along. So thank you very much indeed. And if there are any questions that you want to add responses to post today's meeting, we'll make those available to investors on the call as well. Tarek, I know investor feedback will be particularly important to you and to the rest of the management team, and I'll shortly redirect those on the call to give you their feedback. But before doing so, I wondered if I could just ask you for just a couple of closing comments just to wrap up with, and then I'll send investors to give you their feedback.
Well, as I said before, very pleased that people came along for the meeting, and we're pleased with our year-end results. We feel that we returned to profitability and we increased our revenue. And moving forward, we think there's good prospects for Quiz to increase revenues and profits in the coming years. So we're still excited about the business, and we're still intending to invest in the business and increase the profit revenue and increase the share price.
That's great. Thank you very much indeed for your time this afternoon and for updating investors. Can I please ask investors on the call not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Quiz PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.